This is the 6th or 7th annual halftime report, and we're going to do this for as long as it's necessary. Again, the reasons we do this is twofold. One, it's part of an ecosystem of advice. For us, it's a way to keep you guys up to speed on what we're thinking so that you're not surprised when we do things, for the most part. Second reason, very minor reason, is this is one of the ways, or the way, we grow our practice, is word of mouth. And so this is an opportunity for folks to invite other people just to see what it is and experience the philosophy without having committed to anything. You can ask questions, kick the tires a little bit, and that's how people get to know us a little bit before they become clients. Okay. We're going to do 4 things. As per usual, we're going to start with some new words, not new words, but things that we've heard in the news in the last 6 months as a warm-up. And then we're going to talk about where we've been, where we are, and what we're watching. Okay. Words we learned. Polar vortex. So was anyone on the East Coast or Midwest earlier this year? Yeah? What did you think of the polar vortex? It was cold. You know what it is, right? Does anyone have any question about what these things are? Does this even work here? No? Okay. So polar vortex, very cold. My wife and I were skiing in Canada, so in the end of January, it was awesome for us. They had more snow where we were than they had in like 6 seasons prior to that. However, in South Dakota, where my parents are, the trees got covered in heavy snow. Apple trees snapped in half. Most of the many branches came off. Many trees are no more because of the storm. And in the East Coast, it was freezing cold, and it was just kind of miserable. So that's polar vortex. Okay, ISIS. What is ISIS? See. Islamic State, Iraq, Syria. They want to overthrow and do a caliphate. Okay. Gamification. You guys know this one? Gamification. So gamification, this is a concept of C, right? It's a concept spreading like wildfire. Educators and companies apply game design thinking to non-game things. So think about our new healthcare. Think about making a game a point structure around walking a number of miles. So in our office, we could do something like, and businesses are doing this, they're saying, let's have a competition among employees to see who walks the most, and everyone gets a pedometer. Yeah, we wouldn't do it in our office because Nancy would just win off. We can't have that. So the idea is to turn something that is good for us into a game so that we will do it more. My son, again, he plays soccer, and he came home yesterday and he said that it's a game already, so you don't need to gamify it. But they gamified juggling, and at the end of the week, the person that has the highest total juggle score, it's totaled from every day, gets a prize. And so they turned it something that they wanted them to do, which is sort of a boring pastime of soccer. I love doing it, he loves doing it, so it works, but some kids are like, what are we juggling for? Let's go play. So it gets them to do it, gets some touches on the ball, gets them control, helps them learn how to control, and gives them points, and so they can win a prize, that kind of thing. Gamification, okay. Where we've been. So far in 2014, or this is through June 30th in 2014, it's been kind of an average year. Right? Stock market was up 6. At the end of this month, it's up 7.5. A little bit better than average. Treasuries are sitting at 2.5. So bond yields, we expected them to go up. They haven't. We'll talk more about that. Emerging markets are up a little bit less than the U.S. This is maybe a transition period. The U.S. did really well last year and is still outperforming this year. Maybe that handoff occurs over time. Emerging markets, last 10, 15 years, emerging markets have outperformed U.S. markets. So we may see that handoff continue. At the same time, gold, and I use gold as a proxy for commodities, commodity index and gold specifically did really well in the first half. And we'll talk more about that as well. The interesting thing, and I don't think we've had this on this before, but right now, volatility is at an all-time low. So what is volatility? It is the zigs and zags we feel. And the zigs and zags are sort of non-existent right now. And that's kind of strange given what we see going on in the world. Like we would expect to have more volatility than we are seeing. And so it's off 20% actually at the end of June, off maybe 28% at the end of July. So volatility keeps going lower. And this is an opportunity maybe to think about a portfolio hedge, because when markets collapse, volatility goes up. So it's something that we're looking at as a possible portfolio additive. Janet Yellen, December 18th, last year, said that this year we'd have 2.8 to 3.2% growth without a negative quarter. Does anyone know what happened in first quarter? How negative? No, don't answer that. This will come later. Pretty negative, very negative actually. And yeah, right? Okay, we'll talk about that too. I love this, lead-ins. Wall Street analysts, by and large, are pretty accurate. Why? Because they always assume average markets going forward. They always kind of say, oh yeah, the market will go up 10%-ish, plus or minus 3 or 4%. And they've been right, because this year's been kind of an average year. So that doesn't really say much that they're doing well, okay? This is where they've been wrong, and this is where we were wrong. We think that rates will eventually go up. The cost to us of being wrong is that we didn't make a lot of money. So we didn't lose money in this decision that we made, whereas the flip side is if you owned a lot of fixed income and rates did go up, you would have lost money. So see, that's kind of a decision that drives what we do in the office. We try to find a way that's not correlated or that the risk justifies it, where we can make some money for you guys and for ourselves. The one person that got it right is this guy. But here's an interesting story. So October of last year, Bill Gross talks about, and the markets are doing well, and he says, and the Fed comes out and says, I think at the time it was Ben Bernanke, comes out and says, there's no question we will be raising rates eventually. And the market goes haywire in fixed income. He loses a bunch of money in September, October of last year. Investors pull their money out of his fund. Who outperforms the next 6 months? Him. Because he's right, he's just early in sometimes. Like he's absolutely right. Rates will go up from here. We just don't know when, how fast, etc. Okay. How many people have seen this movie? Really? Just 4? Of course, Noah has, with Gracie.
I've seen it like 5.
Yeah, me too. Okay. You know what this movie is? Frozen? Okay. So this is what you were talking about earlier. Like the first quarter of this year, it was cold. Coldest winter in 25 years. Everyone is blaming the weather for what was a really, really bad GDP print. So gross domestic product was really low, and we'll talk about that specifically in a second. But it's interesting that the first quarter of the year is very highly correlated with weather. So why is it that the weather affects this year? Why did the weather affect the economy? When it's so cold and it's rainy and it's nasty, how does that cause a bad economy? Why does that matter? That's right. 70% of the U.S. economy is consumption, is our consumption. We don't go to the doctor, we don't fill the car with gas, we don't shop, we snuggle up with a book or with a TV show or whatever, and we go dormant. That's what happened for 2 months of the first quarter. 17th worst quarter in U.S. economic history, okay? It was really, really bad. So this is a chart of the 25 worst. And notice the last line. Recession, question mark? Yes, 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 yes. One no. The one no is the one we just had, okay? So what it's saying is every single time we've had a GDP print of negative 1.73 or worse, we've had a recession. Do you guys remember what a recession is? What is the technical definition of recession? 2 quarters, Paul, thanks. 2 quarters of negative GDP growth. And so 100% of the time in these, when we have lower than one print of negative 1.73 or worse, we have a recession, which means either the next quarter or the prior quarter has to be negative as well. Okay, so Q4 of 2013 was positive, 2-ish%. It was just reduced in the revisions. And we just got the print this morning for Q2. Do you remember what the print was? Did anyone hear what it was? 4%. Huge upside. It's a quarter, right? And when you average them together, it's still the same kind of low growth kind of a pattern, but it's still positive. So we didn't get it this time. So we have this It's a no. The first time in this history where we've had a no, we've had that low of a print. Interesting. But 2.96% negative. Now, when you saw this in the media, did you see 2.96 or did you see 2.9? I always saw 2.9, negative 2.9. If you round negative 2.96, what does it round to? It's interesting. I don't know why they do that. I kind of do, but okay. So, but it doesn't matter. The GDP number is almost meaningless in terms of market context. And that's what the right side here says. The average one-year return after that really horrific negative print in the S&P 500 is 16%. And 80% of the time it's positive. So don't get worked up about a negative GDP or the positive GDP. It really has nothing to do with how the stock market reacts. Okay. Another thing that happens is the Fed stayed the course. Now, I'm going to have to point over here. So we reduced rates down to 0. We held them there. And now we've pumped money. We've done bond buying for a long time, $85 billion, and now we're tapering. So this is bond buying. We're pumping money in, pumping money in, pumping money in. Here we're tapering. So it's not like we're not tightening anything. We are just being less easy. So if the Fed buys 0 bonds, does nothing, that's not tightening. That's just, they're doing nothing. So they're still buying bonds, but now they're buying 25 billion instead of 85 billion. So they're still being accommodative. They're still being very supportive of markets. They're still trying to boost employment. They're still trying to do all the things we want them to do. But they're slowing that action. And the question becomes, when they go from tapering to just holding on, like now a bond matures, do they take the money from that matured bond and reinvest it? That's what they're going to do for a while. And then they're going to start tightening. When a bond matures, they're going to let it mature, and then maybe they'll actually take money and, or maybe they'll start selling some of the bonds out of their inventory, okay? So that is tightening. This is still easing, so we're still easing. It's still very accommodative, okay? At the same time, the bull market keeps going forward. Again, 6% by the end of the year. Fed is accommodative. Bond yields stink. So what are the other options? You can put it in savings. You can buy a 1% treasury, 2.5% corporate bond, or you can buy an equity. You get some return from dividends, and you get some maybe upside. So you see a lot of that rotation happening. That's one of the things you see in the equity markets. First month negative, rest of the months have been positive. Bonds are doing well. Remember, we expected that bond yields would go up, which means prices would go down. Hasn't happened yet. In fact, the vast majority of pundits were surprised. I was surprised as well. I thought bonds would keep going up from where they started going up in September. It didn't happen. They were reversing, gone back down. Again, that didn't cost us anything except opportunity, right? Okay. All right. So this is just a little video. This is how the economy works, by the way.
Mr. Daniels.
Mr. Daniels.
Look at this.
What's
this?
The numbers, they keep getting bigger and bigger.
The clicks are off the charts.
Yeah.
Yoshi, it's Walter. We're back.
Yes, sir! Ay! Number! Order! Motto, tracking! More shipping!
I need more trees. More trees? I'll get you more trees.
Hey, take a look at wood pulp.
Whoa. Everything you got on wood pulp right now.
He really loves that thing.
That's how it actually works. All right. So did anyone notice what the name of that encyclopedia was? Well done. It was Encyclopedia Atlantica, but the typeface exactly like Britannica's typeface. I had to watch it twice to see that. I'm very impressed, actually.